most beginners blow up their account before they learn what an edge is. The reason isn't strategy, it's order.
If you're about to open a trading account for the first time, here's the number that should shape every decision you make. Between 70 and 89% of retail CFD accounts lose money. That's not a clickbait stat. That's the figure regulated brokers in Europe are legally required to publish every quarter. And here's the part most beginner guides skip. The reason most people end up in that 70 to 89 isn't bad stock picks. It's 4 decisions they made before they ever placed a trade. Asset class, account wrapper, position size, broker. Get those 4 right and you're not guaranteed to win, but you're no longer the default loser. Get them wrong and the market doesn't care how good your chart reading is. Let's go through them. First decision, what you actually trade. There are 6 asset classes a beginner runs into: equities, ETFs, Forex, CFDs, options, futures, and crypto. They are not equally beginner friendly, not even close. Equities, actual shares of real companies, are the cleanest place to start. You get audited financials, regulated disclosure, analyst coverage, and an underlying you can intuitively understand. You know what Apple does. You don't need a macro model to value it. ETFs sit right next to equities, a basket of stocks and a single ticker, like SPY for the S&P 500. If your account is under $5,000, an index ETF is often the right first position before any single stock, because diversification kills single name risk. Now the other end of the spectrum. Forex is the biggest market on earth by turnover, but for retail traders, it's structured as a CFD, a leveraged bet against your broker, not actual currency ownership. Leverage runs 30 to 1 in Europe, 50 to 1 in the US, and 500 to 1 plus offshore. Combine that with 24-hour markets and macro complexity, and Forex is the hardest asset class to learn on. CFDs across the board carry that 70 to 85% retail loss rate. Options price on 3 dimensions at once: direction, time, and volatility. And that third dimension is what eats beginners alive. Crypto has the worst beginner outcomes of any asset class, full stop. The lesson? Pick one, master it, then add a second. Second decision, the wrapper. This is the one beginners skip and then regret at tax time. Where you hold the trade matters as much as what you hold. In the UK, a stocks and shares ISA shields up to £20,000 a year of gains from tax entirely. In the US, you've got traditional IRAs, Roth IRAs, and standard taxable brokerage accounts, each with different rules on contributions and withdrawals. Canada has the TFSA. Australia gives you a 50% capital gains discount on anything held over 12 months. The wrong wrapper costs more than a year of trading mistakes. Match the wrapper to your tax situation before you fund a single dollar. Third decision, and this is the one that actually keeps you alive: position sizing. Never risk more than 1 to 2% of your account on a single trade. Never let your daily loss exceed 3 to 5% of your account. That's it. That's the rule. Sounds boring. It's supposed to. Here's the math. On a $10,000 account, 1% risk is $100 per trade. 8 losing trades in a row at a 50% hit rate, which happens to everyone, costs you $800. Painful, but you're still in business. Now break the rule and risk 10% per trade. Same 8 losses, you're down most of your account, and statistically, you're done. The reason even profitable traders survive 20 to 40% drawdowns is they sized for them. Position sizing isn't risk management, it's survival. Fourth decision, the broker. 6 things matter in this order. 1. Regulation. Tier 1 only. FCA in the UK, ASIC in Australia, SEC and NFA in the US, SISEC and BaFin in Europe. Tier 1 regulation means client fund segregation and a compensation scheme if the broker fails. Offshore brokers offering 500 to 1 leverage and a sign-up bonus? That bonus is not free money. It's the price of giving up your recourse. 2. Jurisdictional fit. The broker has to accept your country and offer the wrapper you need. 3. Asset coverage. If you want US stocks, UK shares, and crypto, you may need 2 accounts. 4. Cost structure. Read the full fee schedule, not the marketing page. Zero commission equity trades just shift the cost to spread or payment for order flow. And watch for the hidden ones: FX conversion fees, inactivity charges, withdrawal fees. 5. Platform quality, including paper trading. 6. Can you actually reach a human when something breaks? Okay, 4 decisions made. Now the 90-day plan that turns them into a real trader instead of another statistic. Weeks 1 and 2, foundations. Read the SEC's investor materials, FINRA's education site, the FCA's investing guide. Pick your jurisdiction, your wrapper, your one asset class. Weeks 3 and 4, open the account, fund a small amount you can genuinely afford to lose, and open a paper trading account on the exact same platform. Weeks 5 through 8, you don't trade real money, you paper trade. 20 to 30 simulated trades. Master the order types: market, limit, stop loss, stop limit. Because using the wrong one in a fast market is how beginners get hurt before they've even learned anything. Weeks 9 and 10. First live trades. Smallest size your broker allows. Journal every single one. Screenshot, reasoning, outcome, lesson. Weeks 11 and 12. Compute your win rate, your average win, your average loss, and separate the strategy losses from the psychology losses. They are different problems. At day 90, you make a real decision. Continue or stop. Continue if your journal shows you can identify and learn from mistakes, if you can sit out flat markets without forcing trades, and if the losses didn't hurt your finances or your sleep. Stop, without shame, if you revenge traded after losses, if you sized up after a winning streak and gave it back, or if you realized buy and hold ETFs actually suit you better. Sunk cost continuation is the worst outcome. The market doesn't care how much time you've already spent. One last thing. Remember at the start I said the 4 decisions matter more than chart reading? Here's why. In 2001, 2 researchers, Barber-odean, pulled the records on 35,000 US brokerage accounts. The best predictor of who survived wasn't intelligence, wasn't capital, wasn't access to information. It was temperament. Overconfident traders traded 45% more and lost nearly a full percentage point more per year for the extra activity. The trader who can sit on their hands when there's no clear setup, accept a loss without revenge trading, and resist the urge to do something during a quiet market. That trader has a structural edge over every cleverer person in the room. That's the real edge. So the verdict: start with equities or a broad market ETF. Tier 1 regulated broker, matched to your wrapper. Risk 1 to 2% per trade. Paper trade before you go live. Treat the first year as tuition. And if your journal tells you the temperament isn't there, stop, without shame. The best trade you'll ever make might be the decision not to trade at all.
Treat year 1 as tuition. Start small, trade slow. Full breakdown linked in the description.